Welcome back, everyone, to Stock Talk. Today, we're diving straight in. We're looking at Zeekr Group's Q1 2025 financials. That's ticker ZK.
That's right. The results just came out May 15th, 2025. We're working directly off of their official earnings release.
And the mission for you listening. Get the key takeaways on Zeekr's performance and strategy quick and clear. And hey, if you like what we do here on Stock Talk, please hit subscribe, maybe give us a like.
Yeah, share it, leave a comment. We actually do read those. Helps us know what you're interested in.
Okay, let's get into it. Q1 2025 for Zeekr. What's the big picture?
Well, the picture looks pretty strong, actually. Deliveries first, 114,011 vehicles total. That's up a healthy 21.1% compared to Q1 last year, so good growth there.
Okay, solid growth. But deliveries are one thing. What about, the money side, profitability?
That's where it gets really interesting. Their vehicle margin saw a big jump. It went from 13.1% last year up to 16.5% this quarter.
Wow, 16.5%. So that's quite a bit more profit on each car they're selling.
Exactly. It points to better efficiency, maybe better pricing power, too.
And how did that translate to the overall financials? Total revenue.
Total revenues were RMB 22.0 billion. Now, that was only up 1.1% year over year, a modest increase.
Okay. Only 1.1% revenue growth, but margins jumped. How does that work?
We'll get into the breakdown, but the really striking number, I think, is the net loss. It shrunk massively, down over 60% to RMB 763 million.
60% reduction in loss. Okay, that is significant. That's a big move towards actually making money.
Huge move. And the report suggests this isn't just luck. It's down to the Zeekr and Lynk & Co. integration really starting to work. They're sharing platforms, managing the supply chain better. The synergies are kicking in.
Right, those synergies they've been talking about.
Yeah.
So let's dig into that revenue number. RMB 22 billion total. You said vehicle sales were the key.
Yeah, absolutely. Vehicle sales themselves were RMB 19.1 billion. That part was up 16.1% year over year. Strong growth there.
Okay, so the cars are selling well. What dragged the total revenue growth down to just 1% then?
It was the other sales and services category. That actually fell quite sharply, down about 45%, mostly because they sold fewer battery packs separately and did less external R&D work.
Oh, okay. So the core car business is strong, growing nicely, but these other sort of secondary revenue streams dipped.
Exactly, which underscores, the fundamental health of their main vehicle business.
Got it. So circling back to profitability, that vehicle margin hit 16.5%. What about the overall gross margin?
Gross margin also improved nicely, up to 19.1%. That's a 280 basis point improvement year over year.
280 basis points. Yeah, that's a solid gain on overall profitability before operating expenses.
And here's a kicker. If you look just at the Zeekr brand, their premium EV line, their vehicle margin hit an amazing 21.2%.
21%. Okay, that is impressive. That's up from what, last year?
Up from 14.4% last year. That really shouts premium positioning, doesn't it? They're getting good prices for those Zeekr models.
No kidding. And that high Zeekr margin must have really helped the overall gross profit number.
For sure. Gross profit jumped 18.8% to RMB 4.2 billion.
Okay, so gross profit up almost 19%, but the net loss reduction was even bigger, over 60%. How do they manage that? Better cost control elsewhere.
Seems like it. That net loss figure down to RMB 763 million from nearly RMB 2 billion last year is just, it's a massive improvement.
And is there an adjusted figure? Sometimes they give a non-GAAP number.
Yes, they do. The non-GAAP adjusted net loss looked even better. It decreased by 66.5% to RMB 640 million. So stripping out some, non-operational or one-off items, the picture of improving operational efficiency gets even clearer.
Okay, financials are definitely painting a picture of progress. Let's talk about the actual cars again, those 114,000 deliveries. How did that split between Zeekr and Lynk & Co.?
Good question. Zeekr delivered 41,403 units. That's up 25.2% year over year. Strong growth, and remember, with that very high 21.2% margin.
Right, premium driving profit. And Lynk & Co.?
Lynk & Co. delivered 72,608 units, also growing, up 18.9%. And what's key for Lynk & Co. is that over half, 52.4%, were new energy vehicles, NEVs.
Well, interesting. So Lynk & Co., which maybe has a broader range, is really pushing into electrification.
Exactly. It shows that transition is well underway. Their vehicle margin was lower, though, at 11.4%.
So Zeekr leads on margin, Lynk & Co. on volume, and maybe the NEV transition pace within its segment. Makes sense.
Yeah, and together the report mentioned their global user base is now over 1.9 million people. That's a lot of drivers.
1.9 million.
Yeah.
Yeah, that's a significant footprint. And is the momentum holding up after Q1? Any more recent numbers?
They did give April 2025 figures. Total deliveries were 41,316. Zeekr had 13,727, and Lynk & Co. had 27,589. So yeah, looks like the positive trend is continuing into Q2.
Good to see. Okay, let's shift gears to the exciting stuff. New cars, new tech. What's happening on the product front? Zeekr first.
Right. Zeekr launched the 007 GT in China back in April. It's their second shooting brake design, and the performance sounds pretty wild. 0 to 100 kilometers per hour in just 2.95 seconds.
Whoa, under 3 seconds. How are they doing that?
Advanced silicon carbide e-motors, really pushing the tech envelope for performance EVs.
Okay, that's one for the speed enthusiast. What else from Zeekr?
At the Shanghai Auto Show, they unveiled the Zeekr 9X. This is positioned as a flagship luxury SUV. And significantly, it's their first model that will offer a hybrid powertrain option alongside the pure electric.
The Zeekr Hybrid. That's a strategic shift, diversifying the powertrain options.
Seems like it. And they're planning a global launch for the 9X in Q3 2025. So aiming beyond China.
Global ambitions clearly stated there. Okay, what about Lynk & Co.? Any new metal from them?
Yep. They started deliveries of the Lynk & Co. 900 in late April. It's a big six-seater family SUV built on the SPA Evo platform that's a shared architecture, again showing those synergies with the wider Geely Group.
Right, platform sharing helps with costs and development speed. Any cool tech in the 900?
Oh yeah. The top version gets something called the G-Pilot H7 package. It runs on an NVIDIA Drive AGX Thor chip. We're talking 700 TOPS of processing power.
700 TOPS. For listeners, TOPS means trillions of operations per second. That's a huge amount of computing power for driver assistance. Suggests very advanced capabilities.
Extremely advanced. And it seems to be hitting the mark. They mentioned over 40,000 pre-orders for the 900 since December.
40,000 pre-orders.
Yeah.
Okay, that's strong initial demand. People clearly like what they're seeing. So all this new tech, new platforms, new models, that costs money. How's that showing up in their R&D spending?
R&D expenses were definitely up, increased by 25% to RMB 2.9 billion. And the company explicitly links this to developing these new vehicle platforms.
You got to see that as investment, right? Investing in the future product pipeline and those shared platform efficiencies.
Exactly. It's spending now to hopefully save later and innovate faster.
Makes sense. What about other operating costs, like sales, marketing, admin, SG&A?
That's the other side of the coin. SG&A expenses actually decreased, down 9.2% to RMB 2.6 billion. They attribute this to an efficiency program they kicked off this year.
Interesting. So investing heavily in R&D for the future, but tightening the belt on current operational spending. That's disciplined.
It seems to be working. It all flows through to that better bottom line we talked about.
Right, the loss from operations improved significantly too, didn't it?
It did, down 25.7% to RMB 1.3 billion on a standard basis, and the non-GAAP adjusted loss from operations, down even more by 32.8% to RMB 1.1 billion.
So clear, tangible progress towards profitability from the core business operations.
Definitely. Stronger sales, better margins, and cost control starting to bite.
Okay, almost there. Let's just quickly touch on the balance sheet. Financial health snapshot. Cash position.
Looked pretty solid. They had RMB 9.9 billion in cash and restricted cash at the end of March. That's a decent cushion.
Okay, good liquidity. What about inventory?
Inventory was stable at RMB 10.3 billion. Seems like they're managing production and sales fairly well. No major red flags there.
And debt. Growth companies usually carry some debt.
Yeah, they have both short-term and long-term borrowings listed. Pretty standard stuff for a company in this growth phase. They do note a shareholder deficit on the balance sheet, but again, you need to see that in context. It reflects the heavy investment phase, and importantly, the profitability trend is moving strongly in the right direction.
Right, context is key. Okay, so wrapping up the strategy and outlook, what's the main message from management?
The big theme is really leaning into that Zeekr Lynk & Co. integration. They're talking platform consolidation, supply chain optimization, sharing resources, basically making 1 + 1 = more than 2.
Got it. Any specific comments from the leadership?
Yeah, CEO Andy An talked about the integration being a milestone, hitting that 1.9 million user base and really focusing on premium mobility. And the CFO, Jing Yuan, really hammered home the record profitability and those margin achievements.
So looking ahead, what are their stated priorities? Where's the focus now?
Seems pretty clear. Number 1, global expansion, taking these brands further afield. Number 2, keep improving operational efficiency, push those margins even higher. 3, cement their leadership in premium NEVs. And 4, ultimately deliver better returns for shareholders.
Okay. So if we were to summarize the key opportunities for investors looking at ZK,
You'd say Strong delivery growth momentum, check. Exceptional margin expansion, especially with Zeekr, check. Big global expansion potential, check. The synergies from the brand integration, check. And a really strong, innovative product pipeline, check.
Sounds like a lot of positives.
Yeah.
And the key strengths they highlighted themselves.
Pretty much mirrors the opportunities. They're emphasizing the delivery growth, the vehicle margin gains, the successful integration, that big cut in the net loss, and the product pipeline. They know where their strengths lie right now.
All right, let's try and bring this all together for you, our listeners on Stock Talk. Zeekr Group's first quarter of 2025, it really shows a company gaining traction.
Yeah, I mean, the integration with Lynk & Co. isn't just talk anymore. It seems to be delivering real results, both in terms of selling more cars and, crucially, making more money on each car.
Especially that Zeekr brand margin, over 21%. That's seriously impressive for an EV maker.
Right.
It really speaks to their brand strength.
Absolutely. And when you combine that with cutting their net loss by more than half, well, the path towards sustainable profitability looks much, much clearer than it did a year ago.
So here's something for you to think about after this deep dive. Zeekr is pushing hard into global markets now. That 9X SUV is coming soon with global ambitions. And they're still squeezing out benefits from the Lynk & Co. integration. How much further can they push that profitability? What could that trajectory look like over the next, say, year or two?
And maybe more broadly, what does a more profitable, globally expanding Zeekr mean for the rest of the premium EV players out there? It's getting crowded.
Definitely something to watch. A critical question indeed. And for everyone listening to Stock Talk today, thanks for tuning in. If you found this breakdown of Zeekr's Q1 useful.
Yeah, please do subscribe if you haven't already. Give us that thumbs up. Share it with anyone you think might be interested.
And drop a comment. Let us know what you think or what else you'd like us to cover.
We really appreciate you joining us. We'll catch you on the next one.